Over the last 130 years or so, homeownership has been the dream for most Americans. From the earliest settlers, most of us desire the status of owning a home, as we feel and have been taught to feel that renting is simply throwing away our money. And now once again, and guys, I do say once again because history, for those of us who care to revisit, can teach us some invaluable lessons. And some of those valuable lessons that we learn from history have to do with our economy and our finances. And I think the importance of looking at history right now is because when our economy gets out of balance, and believe me, it's way out of balance right now, what usually follows is a major economic crash. And depending on the financial decisions that we've made leading up to that crash or correction, will affect us all differently in one way or another. And now I believe that we're in for a major economic correction, and that also includes the industry that I serve, the housing market. In my last 30 years of serving the housing industry in one way or another, I have never seen a more unaffordable housing market than we're experiencing right now. Homeownership has evolved in many ways over the last 130 years. However, there are many similarities in every boom and bust where we can learn from history should we decide to do so. Welcome back and thanks for watching. And in this video, we're going to discuss the evolution of the American dream of homeownership. And I'll be sharing thoughts along the way and comparing history to the current housing market, as well as proffer my professional advice to those wanting to buy their first home. As always, I appreciate your thoughts. So if you're comfortable doing so, please drop your comments below. I believe that there's wisdom in crowds and that we can learn from each other. If this is your first time watching, I'm Todd Sachs, a real estate broker here in Maryland, and our channel is dedicated to keeping you informed on everything real estate. And if you like it here, please consider subscribing to our channel and hit that alert bell so you'll be notified when we post content just like this. And as always, guys, don't keep this content to yourself. Please share it with your friends. The share button is below. Now, prior to the Great Depression, which began around September of 1929, like today, home ownership was out of reach for most Americans. In 1900, less than half of the households owned their homes, and this declined to even less home ownership over the next 20 years. And then from 1920 to 1929, the U.S. experienced a decade-long robust economy known as the Roaring Twenties. This boom raised homeownership rates as businesses were thriving and Americans were making more money than ever. This enabled them to purchase a home instead of renting. And during the 1920s, America's economy grew 42% as mass production spread consumer goods throughout the entire United States. And in 1922, there were 60 radio stations broadcasting news, weather, music, and talk shows. I guess just like this. And by 1925, more than 25% of families owned a car. In 1923, the stock market began a 6-year bull run. And in 1926, the Air Commerce Act authorized commercial airlines. In 1928, stock prices rise to 39%, and the Fed responds to all of this out-of-control consumer spending by raising interest rates from 1.5% to 5% in the Fed's attempt to stop speculation. And in 1929, the number of people flying around in commercial airplanes had increased from 6,000 in 1926 to 173,000. And in 1929, there were now 26 million cars registered. And then guess what? About a year after the Fed raised the discount interest rate to 5%, wham, here comes the Great Depression. The Great Depression began in August of 1929, and by October, the stock market crashes. The Depression was said to be fueled by not just the stock market crash, but a collapse of world trade, government policies, bank failures, and the collapse of our money supply. And during the decade-long Great Depression, Americans struggled financially, and by 1940, homeownership rates had fallen to the lowest level of the century to 43.6%. Then from 1930 through 1945, we had World War II. And coming off of the Great Depression and the war, we had a massive housing shortage, and any available homes back then, just like now, were unaffordable. The federal government responded by building highways, critical infrastructure, and then they cut red tape in order to create incentive programs for home builders and developers to build affordable housing, spurring a time of much needed housing development. During this time, the federal government also initiated loan programs to make home mortgages more affordable and more available to home buyers. And they did so by extending loan terms to 30 years and lowering down payment requirements. This allowed homeownership to rise, but also by making monthly payments more affordable, it allowed for higher profits for builders and developers, and guess what? The government as well. And as the prices of homes increased, this brought homeowner appreciation. Therefore, the American dream of homeownership was now fueled. Homeownership rose from the trough of 43.6 in 1940 to 64% in 1970. The federal government's intervention in housing to increase homeownership had worked. And in an attempt to keep housing demand high for homeowners, the federal government then created the Federal Housing Administration in 1934. This provided insurance to mortgage lenders to help safeguard the banks from a homeowner's default. This was very necessary because at the creation of the FHA's insured mortgages, 25% of homeowners were in default of their home loan. By reducing the bank's risk on home loans, this increased the bank's thirst to lend money to more home buyers. Up until then, commercial banks only liked to lend money to businesses. And in 1938, mortgage lenders got yet another federal boost. Congress created the Federal National Mortgage Association. We now know that as Fannie Mae. This association fueled the secondary mortgage market where mortgages are bought and sold, allowing banks to sell their loans, freeing up more cash to make additional loans. And what came later in 1981? The creation of the mortgage-backed securities. But wait, before the government started buying and dealing in mortgage-backed securities, we had to get through the 1970s. In the 1970s, inflation averaged 7.1% annually, and it topped out at 11% in 1979. It just so happened to be the same rate as a 30-year fixed mortgage. The primary reason for the 1970s runaway inflation was the excessive printing of money. This caused home prices to soar. Sound familiar? Excessive money printing actually caused inflation and a housing bubble? So on money.com, they headlined an article in November of 2022. It said, "Then and Now, 1980. This isn't the first tough housing market we've faced." This article is referring to a 1980 story that headlined "Bottom Dollar for a Tip-Top House." The writer was exploring a housing market that was in flux and bears more than a few similarities to what we're experiencing today. As I had mentioned, in the late 1970s, the economy was facing a tough time. Inflation was running at about 14%, and that was thanks to 2 oil embargoes in the previous years that had sent consumer prices skyrocketing, including home prices. Nationally, home values had increased 14% in 1979. Although many housing markets saw prices grow by more than 20%. It was a seller's market back then for sure. And back then, guys, buyers were purchasing homes regardless of their conditions. Okay, stop. Does that sound familiar? By the time this story was written, the Federal Reserve, which started raising interest rates to bring inflation back under control, caused mortgage rates to surge to 15%. A huge jump given that rates averaged between 8 and 10% from 1973 to 1978. Guys, many of the buyers back then couldn't afford the higher mortgage payments. And this halted home sales and home prices fell. Now, let me read this 1980 headline again. Bottom dollar for a tip-top house. Home prices peaked in 1978 and the Fed raised interest rates, and from 1978 through 1982, home sales fell 50%. And in 1982, only 2 million homes were sold. It took almost 20 years until 1996 before home sales exceeded the peak of home sales in 1978. And then from 1996 through 2006, the real estate bubble had inflated once again. And when it popped this time, it created a housing crash like never before. From the peak in 2006, over the next several years, the housing market and the overall economy collapsed. And for almost a decade, we experienced and struggled from what was now known as the Great Recession. And from 2007 to 2010, there were an estimated 3.8 million foreclosures. That's almost 4 million households losing their American dream due to not being able to afford their home. Okay, so listen to this. From 2011, we have watched median home prices increase 112%. From $221,000 to $468,000 in the third quarter of 2022. The shocking part of this is that 45% of that increase happened from 2020 to 2022. That's just 2 short years. And for some markets in the U.S., they experience even higher housing price growth. So to all my industry friends and first-time buyers out there, and to anyone that says that home prices will never go down in price, can we learn anything from history as it pertains to our economy and the housing market? I think that we should. And it may not repeat itself exactly, but if you look back at the facts that I just mentioned, it sure echoes it very well. Throughout the history of the United States, everything runs in cycles, especially booms and busts and three-piece suits. And as I mentioned in the beginning of this video, since I've been serving the housing industry since 1989, I have never witnessed a housing market this unaffordable. And I've never watched buyers get so emotionally charged about competing for buying a home, waging all of their hard-earned money for their stake in the American dream of home ownership. Recently, our wages have not kept up with inflation. Inflation, as we know it, has been a runaway train for almost 3 years now. And the Fed's recent rate hikes have been more aggressive than any other time in our history. And this has caused in a very short time a drastic decline in home sales. And in my opinion, the only thing that is holding this housing market on by a thread is our current job market and the tight supply of homes. And I'm here to tell you guys that we are now seeing an increase in the supply of home inventory. And pretty soon, this entire housing market will be solely dependent on our jobs market and the Fed's ability to not crash land this economy. There is a great uncertainty in this overheated and overinflated housing market. And if you're a first-time home buyer looking for a home, this is my advice. If your cash out of pocket required to buy a home, including your down payment and total fees associated with buying the home, leaves you with less than 6 months of savings to pay bills should you experience a personal economic downturn, I would sit this one out, at least for the next several months. We'll know a lot more then. Thank you so much for watching this video. And if you liked it, guys, hit the thumbs up. It'll let me know that you did. And as I mentioned before, don't forget to subscribe, smash that alert bell. You'll know every time we upload content just like this. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.